$94.34. Silver just did something it hasn't done in 45 years, 6% in a single day, outperforming gold, breaking through resistance levels that held for decades. And while everyone's celebrating the move, I keep asking myself three questions. Why did COMEX trading halt during a 159 million ounce sell order? Why are China and Canada telling citizens to evacuate Iran right now? And why is the gold to silver ratio collapsing to levels not seen since 2021? My theory is this: we're not watching a normal rally. We're watching the final stage of a pattern that's played out twice before in modern history. And both times, silver didn't just rise, it exploded. 127% in 60 days after the last trading halt. 713% in 12 months during the 1979-1980 spike. And right now, every technical, fundamental, and geopolitical indicator is screaming the same message. This is the setup. The question isn't if silver hits $100. The question is how fast it gets to $200. I'm not a financial advisor. This isn't financial advice. This is pattern recognition based on COMEX data, monetary metrics, geopolitical developments, and historical precedent. And what I found suggests we're in the acceleration phase of a move that could redefine precious metals markets for a generation. Let me show you why. Let me give you the pattern first, because once you see it, you'll recognize exactly where we are. 4 stages. Every major silver spike follows this sequence. Stage 1 is accumulation. Silver trades in a range. Institutional buyers position quietly. Premiums stay normal. The public isn't paying attention. This can last years. But underneath, smart money is building positions because they see what's coming. Stage 1 is invisible to most people. Stage 2 is breakout. Silver breaks through multi-year resistance. Maybe it's $30, maybe it's $35. The specific level doesn't matter. What matters is the psychological shift. When silver breaks out, momentum traders enter. Technical analysts issue buy signals, and the move accelerates. Stage 2 is when the market wakes up. Prices rise steadily but not explosively yet. Stage 3 is manipulation attempt and failure. This is critical. When silver starts moving too fast, when institutional short positions get stressed, when delivery demands threaten exchange solvency, something always happens. Trading halts. Margin requirements increase. Technical glitches occur. The system tries to slow the move. Sometimes it works temporarily. Prices correct. Weak hands get shaken out. But if fundamentals are strong enough, if physical demand is real, if geopolitical drivers persist, the manipulation fails. And that failure triggers stage 4. Stage 4 is parabolic eruption. Once the manipulation attempt fails, once the market realizes that physical demand can't be stopped, silver doesn't just rise, it gaps. $10, $20, $30 in days. Not because fundamentals changed, because psychology flipped from fear of missing out to panic buying. And panic buying in a market with limited physical supply creates price moves that seem impossible until they happen. Stage 4 is when silver goes from investment to mania, and fortunes are made in weeks. Now let me prove this pattern to you with 2 historical examples. And then I'll show you why 2026 is setting up for the largest stage 4 eruption in silver's history. Example 1. 1979 to 1980. The Hunt brothers. Silver starts 1979 at $6 per ounce. By September, it's $10. Stage 1 accumulation complete. Then it breaks out. December, $30. That's stage 2. Then January 1980, something happens. COMEX changes the rules. Silver Rule 7. No new long positions allowed. Margin requirements raised drastically. The manipulation attempt. But silver keeps rising anyway, Because the Hunt brothers aren't selling. Physical delivery demands continue. And on January 17, 1980, silver hits $49.45. That's 713% from the start of 1979. Stage 4. Eruption. Now the story ends badly for the Hunts because they were using leverage. But the people holding physical silver? They made generational wealth. The pattern worked. And it worked because Stage 3 manipulation failed to stop Stage 4 momentum. Example 2. 2020 to 2021. More recent, more relevant. Silver bottoms at $12 in March 2020 during COVID panic. By August, it's $29. Stage 2 breakout. Then something interesting happens. November 2020. COMEX trading halt. Officially called a technical issue. Silver was spiking. Trading froze for hours. When it reopened, the move continued. By February 2021, the Reddit Wall Street Bets community targets silver. Retail buying surges, and silver hits $30 again, then consolidates. But here's the key data point. In the 60 days following that November 2020 trading halt, silver rose 127%. Not because of fundamentals alone, because the halt revealed fragility. And markets that are fragile become violent when pressure continues. 2 examples, same pattern: accumulation, breakout, manipulation attempt, parabolic move. And every time, the people positioned before Stage 4 made extraordinary returns. Everyone else watched in disbelief. Now let me show you what's happening right now, because we just witnessed Stage 3, and Stage 4 is loading. March 2026, silver is trading around $88. Then, a massive sell order hits COMEX, 159 million ounces. For context, that's more than the entire registered inventory available for delivery. It's a paper dump designed to push prices down. And simultaneously, trading halts. CME Group calls it a technical issue. But veteran traders know, when exchanges halt during extreme moves, someone big is in trouble. Either a large short position is getting squeezed, or delivery demands are threatening system stability. The halt lasts hours. When trading resumes, silver doesn't collapse. It rallies hard. Within 24 hours, silver is at $94.34, up over 6% in a single day. That's not normal volatility. That's a short squeeze that didn't get stopped. That's Stage 3 manipulation failing in real time. Here's what that tells me. The entities trying to suppress silver, whether for profit or systemic stability, just lost control. The 159 million ounce sell order should have crashed the market. It didn't. That means physical buying overwhelmed paper selling. And when physical overwhelms paper, the paper market is finished. It's only a matter of time before prices decouple entirely. And that's Stage 4. Now let me show you the fundamentals driving this move. Because the manipulation attempt failed for a reason. The underlying demand is real. First, inflation data. Producer Price Index for February 2026 came in hotter than expected. Core PPI up 3.4% year over year. That's producer-level inflation feeding into consumer prices. And here's the mechanism. When producers face higher costs, they pass them to consumers. CPI lags PPI. So if PPI is accelerating, consumer inflation follows. And precious metals are inflation hedges. When inflation rises, gold and silver rise. That's structural demand, not speculation. Second, M2 money supply hits a new all-time high. According to Federal Reserve data, M2 just exceeded previous records set in 2022. What does that mean? More dollars in circulation, more currency supply chasing the same amount of goods and assets. That's monetary debasement by definition. And when currency is being debased, hard assets hold value. Gold, silver, real estate, commodities. The money is flowing out of paper and into things that can't be printed. And silver, with its dual role as money and industrial metal, captures both monetary and industrial demand simultaneously. Third, geopolitical escalation. China and Canada both issued warnings this week for their citizens to leave Iran immediately. That's not normal travel advisory language. That's evacuation-level urgency. And it signals something is about to happen in the Middle East. When geopolitical risk spikes, safe haven demand for precious metals surges. Investors flee uncertainty. They move capital into assets that hold value regardless of political outcomes. Gold and silver are the oldest, most liquid safe havens. If Middle East conflict escalates, if energy supply gets disrupted, if currency markets destabilize, precious metals will gap higher. And we're seeing positioning happen right now. Fourth, the gold to silver ratio collapse. Currently around 56-1. That means it takes 56 ounces of silver to buy 1 ounce of gold. The historical average is closer to 60-1. But here's the deeper context. The natural mining ratio is approximately 8-1. For every ounce of gold mined, roughly 8 ounces of silver come out of the ground. So fundamentally, silver is far more abundant than gold. But historically, the price ratio has been much wider than the mining ratio because gold was money and silver was industrial. Now, with silver becoming both monetary and industrial, the ratio is compressing. If it compresses to 40-1 and gold is at $5,000, silver is at $125. If it goes to 30-1, silver is $167. The ratio reversion alone, independent of dollar debasement or geopolitical risk, could push silver to triple digits. Now let me walk through the COMEX manipulation thesis, because this is where the pattern gets really clear. COMEX is a futures exchange. Traders buy and sell contracts representing physical silver, but most contracts are settled in cash, not metal. Only a small percentage demand delivery. And that's how the system works. Paper claims on silver far exceed physical silver available for delivery. According to COMEX data, open interest represents approximately 800 million ounces. Registered silver available for delivery? About 60 million ounces. That's a 13-1 ratio of paper claims to physical metal. As long as most traders settle in cash, the system functions. But if traders start demanding delivery, the math breaks. Here's the mechanism. March 27, 2026 is first notice day for April silver contracts. That's when traders who want delivery must declare intent. If too many demand delivery and registered inventory can't cover it, COMEX has a problem. So what happens right before first notice day? A 159 million ounce sell order and a trading halt. Coincidence? Or an attempt to shake out longs before delivery demands hit? The timing is suspicious, and the fact that silver rallied after the halt suggests the manipulation failed. The longs didn't exit, they held. And now delivery demands are coming. If registered inventory can't meet them, COMEX will either force cash settlement, which destroys credibility, or allow delivery failures, which breaks the market. Either way, the paper system is under stress. Here's what concerns me most. The last time COMEX halted silver trading under suspicious circumstances, November 2020, silver surged 127% in the following 60 days. If that pattern repeats, we're looking at silver around $210 by late May 2026. Is that guaranteed? No. But the setup is identical. Trading halt, failed manipulation, physical demand overwhelming paper supply, and geopolitical risk accelerating. All the pieces are in place. Now let me show you the supply-demand fundamentals that make this move sustainable, not just a spike. Silver mine production is flat to declining. According to industry data, primary silver mines are producing less year over year. Why? declining ore grades, higher extraction costs, lack of capital investment in new projects. Meanwhile, demand is surging. Solar panels alone consumed over 200 million ounces in 2025. Electric vehicles use 3 times more silver than combustion cars. 5G infrastructure, medical devices, industrial applications, all growing. The Silver Institute projects structural deficits continuing for years. That means above-ground inventories keep draining. And at some point, inventories hit a level where price must rise dramatically to either ration demand or incentivize new supply. We're approaching that inflection point. Here's the market cap perspective. Silver's total above-ground investable supply is estimated around 2 to 3 billion ounces. At $94 per ounce, that's roughly $200 to $280 billion in total market cap. For comparison, Apple's market cap is over $3 trillion. Bitcoin's market cap exceeds $1 trillion. If even a small fraction of capital fleeing equities or seeking inflation hedges flows into silver, the price impact is enormous because the market is so small. A $50 billion inflow into silver could push prices up 20% to 30% because there isn't enough supply to absorb that demand at current prices. That's the liquidity constraint. And it's why silver moves violently when capital flows accelerate. Now let me walk through the stage 4 scenario. Not prediction, pattern-based projection. Silver is at $94. First notice day is March 27th. Delivery demands hit COMEX. Registered inventory can't cover all demands. Some contracts get cash settled, others delayed. The market sees delivery failures. Confidence in paper silver evaporates. Investors rush to physical. Dealers sell out. Premiums explode to $15, $20, $30 over spot. Spot itself gaps from $94 to $110 in a week, then $130. By mid-April, silver tests $150. Mainstream media finally covers it. Retail FOMO kicks in. And by May, if geopolitical risk escalates, if Middle East conflict intensifies, if inflation data continues hot, silver could touch $200 or higher. Not because fundamentals changed, because psychology shifted from skepticism to panic. And panic in a supply-constrained market creates parabolic moves. Here's the alternative scenario. COMEX manages delivery demands. No failures. Market stabilizes. Silver consolidates at $90 to $100 for months. Momentum fades. The move was real, but not parabolic. Which happens? I don't know. But I know the setup. And the setup is more extreme than 2020. More extreme than 2011, and possibly approaching 1980 levels of stress. The difference? 1980 was 2 billionaires. 2026 is global demand, industrial users, central banks, retail investors, institutions, everyone positioning simultaneously. That's not a squeeze, that's a stampede. Here's the risk framework. If you're holding physical silver, you're positioned. The risk is volatility. Silver could hit $120, then correct to $90. Can you hold through that? If yes, you're fine. If no, you'll sell at the wrong time. If you're holding paper contracts, futures, or ETFs, understand counterparty risk. If delivery failures happen, if cash settlement gets forced, your silver might just become dollars at a price you didn't choose. Physical has no counterparty risk. Paper does. And in a crisis, that difference matters. Here's the opportunity framework. Silver under $100 might be the last chance. Not because $100 is a ceiling, because once silver crosses $100, psychology changes. Media coverage increases, retail enters, and prices accelerate beyond that level quickly. Buying at $94 versus $110 is a 17% difference. But if silver goes to $200, both entry points worked. The question is whether you position before the mania or during it. History says before is better, less competition, lower premiums, more time to accumulate. Now let me show you the gold correlation. Gold is approaching new all-time highs, currently around $5,300. If gold breaks $5,500 and runs to $6,000, silver follows. But because of the ratio compression and higher volatility, silver moves faster. A 20% move in gold could coincide with a 50 to 80% move in silver. That's the leverage. That's why investors use silver as a gold multiplier. You believe in precious metals but want more upside? Silver gives you that, with more risk but more potential reward. Here's the geopolitical wild card. If Iran conflict escalates, if oil supply gets disrupted, if energy prices spike, inflation accelerates further. Central banks face impossible choices: raise rates and crash economies, or hold rates and let inflation run. Either scenario is bullish for precious metals. Rate hikes destroy debt-heavy economies, but make hard assets relatively attractive. Rate holds allow inflation to erode currency value, making gold and silver essential hedges. The Fed is trapped, and silver captures that trap in price. Here's what I'm watching this weekend. Middle East developments. If evacuations continue, if military movements escalate, Monday opening could be violent. PPI data is already out, hotter than expected. That's bullish. COMEX delivery data for April contracts. If demands exceed registered inventory significantly, that's the trigger. And Federal Reserve commentary. If they signal rate cuts, that's additional fuel. All these variables are live right now. Let me give you the historical probability framework. Since 1970, silver has had three major bull runs. 1979-1980. 713% in 12 months. 2008-2011, 448% in 30 months. 2020-2021, 127% in 60 days from the trading halt. Average return during bull phases, approximately 429%. If we're in a bull phase starting from the $22 low in late 2024, and silver runs 400%, that's $110. We're already at $94. If it runs 500%, that's $132. If it mirrors 1980 at 700%, that's $176. And if it exceeds all prior runs due to structural factors being more extreme than ever, $200 plus dollars is not speculative. It's pattern completion. Here's what I'm not saying. I'm not saying silver hits $200 next week. I'm not saying sell everything and go all in. I'm not saying this is guaranteed. What I'm saying is the pattern is visible. The setup is extreme. And historically, when we've seen this combination, explosive moves followed. Maybe this time is different. Maybe the manipulation succeeds. Maybe delivery demands are manageable. Maybe geopolitical risk fades. Maybe. But the data says otherwise. The trading halt failed to stop momentum. Inflation is accelerating. Money supply is at records. Geopolitical risk is intensifying. And the gold-silver ratio is compressing. Those are facts. How fast it unfolds is the variable. But the direction is clear. Here's the final question. Are you going to watch silver go from $94 to $150 to $200 and wish you'd positioned? Or are you going to recognize the pattern, understand the setup, and take action while prices are still under $100? Because once silver crosses triple digits, once mainstream media covers it, once retail FOMO dominates, the opportunity changes. You're no longer early, you're chasing. And chasing in parabolic markets is how people lose money buying tops. The pattern is clear. Stage 3 just happened. The manipulation failed. Stage 4 is loading. And if history repeats, The next 60 days could redefine silver markets for a generation. The people who see it position. The people who don't watch it happen. Don't be the person watching. If you want to follow this hour by hour, subscribe. Because this weekend, geopolitical developments could change everything. Monday's open could gap silver $10 higher, or consolidation could give one more entry point. Either way, understanding the pattern, knowing where we are in the sequence, that knowledge is the edge. Stage 4 doesn't wait for you to be ready. It happens. And the people positioned before it happens win. Everyone else learns an expensive lesson about timing. The choice is yours. But silver just told you something at $94. It told you the paper market is breaking. It told you physical demand is overwhelming supply. And it told you stage 4 is coming. Are you listening?